Let's talk about a day the market won't be forgetting anytime soon. Tuesday, August 26th, 2025. It was hit by an absolute tidal wave of selling, the most turbulent day in 3 months, and it left a lot of investors completely reeling. So, what on earth happened? Why did it all go down so fast? And what did it mean for the days ahead? Well, let's break it all down piece by piece.
Just look at that number. Over 6 lakh crore rupees. That's how much investor wealth was just wiped out in a single trading session. To put that in perspective, that's like the entire value of some of the country's biggest companies, just vanishing into thin air in a matter of hours. This was no small dip, folks. This was a massive, value-destroying shockwave.
And you can see the damage right here on the main indices. The Sensex just plummeted down almost 850 points. The Nifty 50 shed over 255. Both lost over a full percent. What's really telling is that the market opened way lower and just kept on falling all day long. That's a huge sign that the sellers were in complete, total control from the opening bell to the close. Okay, so a sell-off this brutal doesn't just happen out of the blue, right? It needs a catalyst. It needs a powerful trigger that just shatters investor confidence. And in this case, that trigger came from one single formal notification that sent shockwaves, not just through India, but across the globe. And here it is, the bombshell, the primary cause. The U.S. administration formally announced an additional 25% tariff on Indian goods. So you take the duties that were already there, you slap another 25% on top, and boom, you're at a massive 50% total levy. This wasn't just some threat anymore. This was real, and it was set to kick in the very next day. The market's reaction, instant and brutal. Now, this sell-off wasn't just about the big, headline-making companies. Oh no, the fear was everywhere. It spread like a virus through every single layer of the market. Let's dig into how that panic actually unfolded. This chart tells you so much. So the Nifty 50, the big guys, they fell about 1%. But look at the mid caps and the small caps. They plunged 1.6% and over 2% respectively. This is a classic flight to liquidity. When fear takes over, investors dump their smaller, riskier stocks, and they rush to the perceived safety of large companies you can sell easily. The pain was just so much worse in the broader market. And the damage was incredibly widespread. I mean, just look at the raw numbers. On the National Stock Exchange, 2,751 stocks went down, while only about 1,167 went up. That's what we call negative market breadth, and it showed an overwhelming consensus among traders. Get out and get out now. But here's where things get really fascinating. Even in a total market meltdown, capital doesn't just disappear. It moves. And on this day, we saw this incredible contrast between sectors that were in complete disarray and one single sector that acted like a safe haven. So amidst that sea of red we saw earlier, one group of stocks actually stood tall. It was pretty much the only sector that managed to weather the storm, and it attracted a flood of money from investors who were desperately looking for shelter. And there it is, the Nifty FMCG Index. It closed up nearly a full percentage point. This is a textbook defensive move. You know, fast-moving consumer goods, we're talking food, soap, everyday stuff, are things people have to buy no matter what the economy's doing. They're insulated from global trade wars, so money just poured into them as a defensive play. All right, so we've seen the safe house. Now let's look at the other side of that coin. For every safe haven, there were multiple sectors right there on the front lines, taking the absolute brunt of the damage. And the losses here were just brutal. Capital market stocks plunged almost 3%. Realty got hammered on fears of an economic slowdown. And banks, especially the government-owned PSU banks, were hit really hard. They're often seen as a barometer for the health of the entire economy, which was now clearly under threat. So we know it was a historically bad day, but we can actually prove, statistically, just how unusual it was. This wasn't just another risk-off day. Quantitatively, this was an extreme outlier, a true anomaly. So here's the crucial question. How do we measure that? How do we go beyond just saying it was a bad day and actually quantify the shock to the system? Okay, here's the data. Now, these numbers measure how far the day's performance was from its 15-year historical average. In stats, anything below minus 2.0 is considered a huge, significant shock. And look at this. Pharma at minus 3.4 standard deviations, capital markets at minus 3.1.
These are truly rare, once-in-a-blue moon kind of events. And check out the other side. FMCG's positive move was also a statistical outlier at almost +2. This confirms it was a genuine shock. To put it really simply, think of standard deviation as a measure of surprise. A value of 0 means the day was perfectly average, nothing to see here. The further away from 0 you get, the more surprising and unusual that day's move was. And this crash was a multi-standard deviation event all over the place. So the crash on Tuesday was the main event, but the market was heading straight into a perfect storm. The next few days were setting up to be a total cliffhanger, with a bunch of high-stakes events that would decide if this crash was a one-day thing or maybe the start of something much, much worse. Okay, just look at this timeline. The market crashes on Tuesday the 26th. Then, Wednesday the 27th was a market holiday. That means traders had a full day to just sit there and stew on this terrible news while those 50% tariffs actually went into effect. And all of this led straight into Thursday the 28th, which just happened to be the monthly futures and options expiry day, a day that's often filled with huge, unpredictable swings anyway. So heading into that critical Thursday, everyone was basically holding their breath and watching three key things. First, how would the market react at the open after having a whole day to process the new tariff reality? Second, how wild would that expiry day volatility get? And third, would the foreign institutional investors who were already selling just keep pulling their money out? And the technical outlook at the time was pretty grim. The analysis was clear. The path of least resistance was down. That support zone on the Nifty between 24,670 and 24,700, that was the line in the sand. If the market broke below that, everyone was bracing for another major leg down.
Which leaves us with the ultimate question. The market was already deeply wounded, the bad news was now a reality, and a super high-stakes, historically volatile trading day was just hours away. Would the market manage to find its footing and defend those critical levels, or was this tariff shockwave just the beginning of a much deeper correction?